Canadian investors love dividends, and there's a really good reason for that. As Canadians, we have access to some of the highest quality dividend stocks on the planet with some real tax incentives to own them in contrast with our international friends. That means that for us as Canadian investors, income-focused investing makes way more sense than it does for most others out there. And when it comes to income investing, there are two Canadian stocks that reign supreme. We're talking about Enbridge and TC Energy, and today, as you can see on the screen beside me, we're putting them head to head. So we're going to talk about what each stock is good at, what kind of investor should own them, and what my opinion is on which is better. Welcome to Golden Arch Investing. My name is Liam. On this channel, we talk about investing in Canada. If that interests you at all, please do like the video and subscribe to the channel. Now, obviously, I'm going to be reading through a Seeking Alpha article here. It's really well put together and has a lot of interesting details and points to compare on these two companies. But one thing it doesn't talk about that I want to start with here, different investors with different goals have different investments that are best suited for them. And so what I say here might not fit exactly what you're looking for. It's a big part of why people say, hey, this is not financial advice, because what works for me might not work for you. Now, in this case, we're talking about two different kinds of income-focused investing. But when I say income-focused, that does not mean that you're just investing for income and there's zero growth. If you wanted to do that, there are way easier and lower risk options you could choose. In this case, when you're buying a dividend stock like this that pays out a fantastic dividend, has paid out great dividends over time, grows its dividend consistently, what you're probably looking for is either total return or for income that outpaces inflation. And I think depending on which of those two things you want, you're going to pick a different name here. Let's go through this article, see how the financials compare, really compare these two companies on their merits. And at the end, I'll talk about who I think is going to buy which stock. So starting out, this is on Seeking Alpha. It's written by Robert F. Abbott. TC Energy or Enbridge, comparing their key financials. Their summary is really brief here if you want to cut straight to the point. Enbridge has stronger revenue growth, higher earnings momentum, and increased capital expenditures, positioning it for better future performance. But TC Energy has historically outperformed Enbridge. They have a higher total return, higher return on equity, but their growth outlook right now doesn't quite look as favorable. Analysts are not as high on TC. Both companies give robust dividends, maintain strong debt profiles, making them solid low risk in the world of stocks, investments for income-focused investors, and the author prefers Enbridge, which brings me to a second point here. I am an Enbridge shareholder, so I am clearly biased in favor of Enbridge. So take that into account when you're listening to what I have to say. Investment thesis. Investors interested in Canadian pipelines have a choice between the two major players, TC Energy and Enbridge Inc. Both are based in Calgary, Alberta, and have American listings using the symbols above. But how do their financials compare? Are there an advantage in owning one rather than the other? After reviewing their key financials, I consider Enbridge to be the better choice for new investors, although TC Energy has outperformed it in the past. Both operate in Canada and the USA, while TC extends into Mexico. Here we talk about sort of the big picture, the main idea. What do these companies do? Enbridge moves 30% of the crude oil produced in North America, 20% of the natural gas consumed in the US. They operate North America's largest natural gas utility, and they have been an early investor in renewable energy. TC describes itself as an extensive network of natural gas infrastructure assets, which is one of a kind. They move, generate, and store energy, deliver it to where it is needed most, to homes and businesses in North America and across the globe through LNG exports. Their natural gas assets are complemented by strategic ownership and low-risk investments in power generation. So on the one side, Enbridge definitely focuses more on oil. TC definitely focuses on gas. Now, obviously, that doesn't comprise the entire business, but it should be something you consider when you're looking to buy one of them, because maybe your future projections for one of those two industries is better than the other. And that might color how you view the safety of one of those companies. Because if, for example, you believe that oil is absolutely out, peak oil was last year and they're going to be done by the 2030s. Well, if you're investing for 20 years, you don't want to own Enbridge in that world, in sort of your worldview. So obviously, which industry you sort of prefer is going to color a little bit your investment choice. TC Energy is about half the size of Enbridge. It's also a little bit more focused, right? TC is on natural gas, Enbridge is on natural gas plus, all this other stuff. Revenue growth, the charts look quite different. You see the Enbridge chart sort of ramps up through 2021, drops down into 23, and then up through 24. TC is kind of the inverse almost. It's up in 21, sure, but then it snipes down in 2022, right back up, right back down. Obviously, when you're looking at revenue charts like this, there are lots of company-specific stories that play out here. This is not like looking at the S&P 500, where it's just sort of a macro overview of the economy in general, the stock market in general. There's all sorts of company-specific things that happened along this time. But clearly, Enbridge's revenues grew a lot faster. One thing I should say, if we sort of cherry pick the data here, we could have made all sorts of different things happen. And that's going to be the case in a lot of these charts. You look at a 5-year chart, well, hey, it's 2025. 5 years ago was something else, hey? And if one industry versus the other got impacted more, that's going to impact how they look on a 5-year basis more. If you zoom up to 10 years, well, 10 years ago, even 2015, talking oil industry, there's a whole nother set of problems there. So keep that in mind as we read through here. Profitability looks better for TC. I'll say it right now. TC's net margin slipped a little bit, but they were sitting at about 30%. You see that on the screen. 30% is where they start and end the period, even though they dipped all the way down as low as 0% throughout. They do end back up at 30%. Enbridge starts at 5, ends at about 10. So Enbridge's profitability, their margins have doubled. Wow, amazing, but are still significantly lower than TC's. However, TC's profitability is clearly more volatile. So, again, you got pros and you got cons. Okay, TC is more profitable, but they're more volatile. Enbridge is growing in profitability, but it's a lot lower. So what do you really prefer? The investor here prefers TC. When you look at return on equity, ROE, you see Enbridge was chilling out at about 2 and a bit, maybe 3 here, and it ends the period almost at 10. Quite impressive growth. Obviously, when you start in 2020, most things are. TC, on the other hand, starts at almost 15, ends in the mid-low teens. So again, TC's ROE is way higher. Enbridge's ROE grew way faster. Earnings growth. Here you got one chart that compares them both, which I love. Color code and everything. Very clearly, the EPS of TC is higher, but starts higher, ends a little higher. Enbridge starts lower, ends a little higher. Enbridge starts below 1, ends at about 2. So TC shows more strength. Sure, they've been higher up, they're staying higher up, but Enbridge has been growing faster. If that continues, obviously that trend might flip. Dividends. The big story here. Enbridge pays out 6%, TC pays out about 5%. Enbridge's dividend has been growing at about 5.5% over the last 5 years. TC's been growing at about 6 and a bit. And the payout ratios are both quite high. Enbridge is at 122.9, TC at 87.67. Now, that does not mean that they cannot pay out those dividends. That Enbridge at 122, scary, sure, but it's because they've bought all these assets, made all these investments, allocated all this money, and are expecting those things to outgrow their problems in order to then drop that payout ratio and continue to be able to raise the dividend. If you believe them or not is up to you, but over 100% is scary for a lot of more conservative, more sort of protectionist, older investors looking to retire off this money that don't want to be sitting there holding the bag if this company starts to drop or if they cut the dividend. Debt levels are both pretty high. Enbridge ends the period here at about 50%, while TC ends the period at about 10%. Different directions each company took. Obviously, again, very similar to the story with the payout ratio there. Enbridge hopes to outgrow the problem. TC hopes to make the problem go away. Which solution you like depends on what you want. Cash flows. Enbridge's cash flows are higher, stay higher. TC's cash flows grow, but don't ever quite catch up. There's a little overlap in 21, but that's about it. Total returns, really important chart. Depending on the kind of investor you are, this might be the only chart that matters to you at all. Because again, some investors are just looking for the max amount of money they can make. They're willing to chill out for 10, 20, 30, 40 years. On this chart, it's very clear that TC destroys Enbridge. However, this is a 10-year chart. Remember what 2015 looked like for the oil industry, which is a much bigger part of Enbridge's business than it is part of TC's now. With that in mind, seeing Enbridge not do great compared to 2015 isn't shocking. And they're still up almost 100%. They've almost doubled in 10 years. However, TC being over 200% is absolutely killing it. So, whether or not the next 10 years look the same would really depend. You could also make the same argument that if you looked at a 5-year chart, maybe you'd see a different thing, but you can see that TC is a little bit more volatile, moving a little bit faster, clearly has outperformed Enbridge. So on a past performance score, TC's kind of beat Enbridge on a lot of things. Depends on the time frames you look at. It depends on the metrics you look at. I'm sure I could cherry pick data to make Enbridge look better. However, the thing you care about is right here, future performance. And here's some really interesting stuff from the author. I'll read it for you. Enbridge's revenue has grown over the past 4 quarters, while TRP's has remained flat. The former has more momentum going into Q2 2025 and has the rest of the year. Oh, Q2 25 and the rest of the year rather than the later. Enbridge's net margin has also grown while TRP's slipped slightly, but at the end of Q1 2025, TRP's margin is roughly 3 times as high as that of Enbridge. Do not expect dividends to make a difference in forward assessments. Earnings momentum favors Enbridge with growth of 6.81% expected, while TC's earnings are expected to decline 2%. They don't consider debt risk a factor going forward since both have strong debt to equity and interest coverage ratios. Increasing capital expenditures by Enbridge and contraction by TC Energy lead me to expect more of Enbridge in the future. On a total return basis, when you note that TC Energy's return is rising sharply while Enbridge is rising gradually, if they continue on their respective trajectories, TC Energy has the edge. However, I also note that TC Energy's chart is more volatile, making it more likely its path will turn down again in the not so distant future. So they prefer Enbridge because Enbridge is growing. But remember what we talked about at the start of this video? Different investors are going to prefer a different thing here. So I'm really going to paint 2 pictures for you. The first one, you are looking at buying something that will outperform inflation. So you're looking at a couple percent a year. And importantly, will pay out a great dividend. In that case, you might be thinking based on the total return chart, oh, I'm looking for Enbridge. But I actually think you're looking at TC. I think the next 5 years, 10 years, maybe even 15 years, TC Energy has set themselves up to be a natural gas and energy player. Now, in a market where natural gas and energy are looking great, with AI coming online, with increased North American industrial performance, with all these new data centers that need to be built, hey, their stock has done great. And it's looked like a growth stock for the last little while. What, 200%, 200-something%, 5 years, 10 years? That's fantastic. But for the next 10 years, I think right now you're looking at we're not talking valuation too much here, but you're looking at a slightly more, you've had a lot of that growth baked in. You're looking at a slightly slower player. They're probably not going to grow all that much. But what they will do is provide a safe, I shouldn't say safe. Nothing is ever safe in the stock market. A safer, comfortable dividend that's raising a little bit every year, quarter, whatever you want to measure yourself by. They're raising their dividend consistently. They're paying you out consistently. And they are beating inflation. They are pretty well protected against most major downturns. There are some downturns that could hit them, but they're not as exposed to a single natural resource as Enbridge is with crude oil. And natural gas, well, yes, it is an absolutely volatile thing. Volatile based on weather, volatile based on LNG demand, volatile based on geopolitical conflict. Absolutely. Their focus is on delivering it to North America. You can make your arguments about how volatile North America has gotten in comparison with sort of historic trends, but you can't make an argument that it's more volatile than other parts of the world right now. Enbridge, on the other hand, this is those total return investors. That's why I own it. I think Enbridge is an ideal dividend snowball candidate as part of a broader strategy of total return. I would not recommend investing 100% in any stock ever. But Enbridge makes a lot of sense as your pipeline play or one of your pipeline plays. If you think that crude oil has a future in Canada, if you think there's maybe some room for expansion in that space, if you think that there might actually be some projects done, there might actually be some expansion in the production facilities and they might need to produce, sort of bring more to market. I also think that Enbridge makes more sense because they have all these projects playing out across North America that'll help them grow the business. I think the 6, 7, 8% return they're expected over the next 5 years each year is pretty great. I think if they compound like that consistently, you're going to see more snowballing effect, more compounding effect that will end up in a higher return than the original TC investor after a certain period of time. It might not happen right away because, again, TC is in just a beautiful space. Can you imagine you're a natural gas and energy company at a time when AI demand suddenly shoots to the moon right? There are TC investors who have made absolute bank, and they should be patting themselves on the back and considering what exactly their goal is with those stocks. But if you're buying now and you're looking for 5, 10, 15, 20, 25 years, is that crazy to think that Enbridge could still be a good play in 25 years? But I think if you're looking right now, it makes sense that that stock will continue to return capital to shareholders at a faster rate. They will provide more value. You're going to see more stock growth in those longer term sort of investment scenarios. And compounding is a beautiful thing. You look at any sort of compounding calculator ever, and you see why that last couple, maybe not 5, but whatever, couple quarters, couple of years, whatever it might be, the end of your portfolio are the most important, because that's when you see the real gains start to tick in. Obviously, neither of these have the sort of staying power of a major financial institution or a massive asset manager or something that's more sort of sector agnostic, doesn't care about energy, doesn't care about financials, doesn't care about tech, and just sort of exists regardless, right? They don't have the staying power of a Brookfield or an RBC, right? If you're looking at sort of stocks you could be buying right now in Canada, these pipelines maybe have a shorter timeline, but it's long enough that there are lots of investors, myself included, that should own these. And I think that if you're a Canadian investor, you're looking for dividends, you're looking for income, these are 2 fantastic stocks to consider, and they should definitely be on your watch list. And now I want to hear from you. Drop a comment below. Which stock did you pick and why? Which do you think's better? Who do you think they're better for? Do you feel like maybe TC is actually a better long-term compounding stock? Why is that? What do you know that I don't? I would love to hear your thoughts in the comments down below. And of course, if you like the video, please like it. If you like what we do here on the channel, please do subscribe. And if you made it this far in the video, I hope I see you in the next one.